Differences between tax and tariff. What is a tax? A tax is a compulsory financial charge or levy imposed by a government on individuals, businesses, or other entities. Taxes are collected at various levels, that is, national, state, or local, and are used to fund public goods and services such as infrastructure, education, healthcare, defense, and welfare programs. Taxes can take many forms, including income tax, a tax on personal or corporate income, sales tax, a tax on the sale of goods and services, property tax, a tax on property ownership, value-added tax, VAT, a consumption tax added at each stage of production or distribution of a product or service, excise tax, a tax on specific goods like alcohol, tobacco, or fuel. Taxes are the backbone of public financing and can be progressive, higher earners pay a higher rate, or regressive, lower earners pay a higher proportion of their income. What is a tariff? A tariff is a specific type of tax imposed on goods and services that are imported into or exported out of a country. Tariffs are used primarily as a trade policy tool to regulate international trade and protect domestic industries from foreign competition. Unlike domestic taxes, which are broadly applied to a wide range of economic activities within a country, tariffs are typically levied only on imported or exported goods. There are two main types of tariffs. Ad valorem tariff. A percentage of the value of the imported good, for example, 10% of the product's value. Specific tariff. A fixed fee, based on the quantity or weight of the product, for example, $50 per ton of steel. Tariffs are most often used to protect domestic industries from cheaper or subsidized foreign goods, encouraging consumers to buy local products. They can also be used as a form of economic retaliation or negotiation in trade disputes. Tax versus tariff. Scope of application. Tax is imposed on a wide range of economic activities, including income, sales, property, and services, and affects both individuals and businesses within the country. Tariff is specifically levied on goods and services entering or leaving a country, affecting international trade. Objective. The primary objective of taxes is to raise revenue for the government to fund public services and social programs. The main purpose of tariffs is to regulate international trade, protect domestic industries, and sometimes raise government revenue from trade. Effect on consumers and producers. Taxes directly affect individuals and businesses in the domestic economy, influencing their income and purchasing power. Tariffs impact the cost of imported goods, potentially making them more expensive for consumers and giving domestic producers a competitive edge. Regulatory role. Taxes are a general tool for economic regulation, influencing consumer behavior, example, higher taxes on tobacco products to discourage smoking. Tariffs are more focused on protecting specific sectors or industries by making imported goods less attractive or more expensive. Objectives of tariffs. Protect domestic industries. One of the main purposes of tariffs is to shield local industries from foreign competition. By making imported goods more expensive, tariffs encourage consumers to buy domestically produced goods, which supports local businesses and jobs. This is particularly important in industries that are still developing or that face unfair competition from foreign companies with lower production costs. Generate government revenue. In some countries, especially developing nations, tariffs can be a significant source of government revenue. While taxes remain the primary revenue generator, tariffs on imported goods contribute to the government's budget, especially when the domestic tax system is less developed. Regulate trade. Tariffs are a critical tool in trade policy, allowing governments to manage the flow of goods across their borders. They can be used to promote or restrict trade with certain countries, depending on diplomatic or economic objectives. For instance, tariffs can be raised to penalize countries engaged in unfair trade practices or lowered to encourage trade agreements. Correct trade imbalances. Countries running large trade deficits may impose tariffs to reduce imports and support local production, thereby aiming to correct the imbalance. By discouraging imports and promoting exports, tariffs can help improve a nation's trade balance. Retaliation and negotiation in trade wars. Tariffs are often used in trade wars as a retaliatory measure. If one country imposes tariffs on another's goods, the affected country may respond by imposing its own tariffs. Tariffs can also be used as a bargaining tool in international negotiations to extract better trade terms. Protect strategic or essential industries. Governments may use tariffs to protect industries that are crucial to national security or economic stability, such as defense, technology, and agriculture. Ensuring these industries remain competitive domestically can be vital for a country's sovereignty and resilience in times of crisis. Conclusion. While both taxes and tariffs are means by which governments collect revenue, they serve different purposes and affect different aspects of the economy. Taxes are broad-based charges on economic activities within a country, while tariffs specifically target international trade. The primary function of taxes is to raise revenue for public expenditure, whereas tariffs aim to regulate trade, protect domestic industries, and sometimes serve geopolitical objectives. Understanding these differences is essential for grasping how governments balance their fiscal needs with their trade and industrial policies.